Hey everybody, I'm Bill Faith, founder of Build Short-Term Rental Wealth. Thank you for joining me today. For those of you that are watching the live broadcast here in the Superhost Library Members Only group, I'm really excited to bring this broadcast and interview to all of you today on the YouTube channel. Stay tuned, man, because this is, I've got a gentleman here for you that's been writing mortgages since 2008. He's done over 2,000 of them, virtually nationwide. There's a handful of states, California, Montana, and a couple in the Northeast that he doesn't write to, but the majority of all of our vacation rental markets, metropolitan areas outside of that, he's writing mortgages, and he's got a really cool website. It's 10percentdown.com. That's TEN, not the number 10, 10percentdown.com. He's a wealth of knowledge, and here's the really cool thing. Number one, we're going to dive right in, and we're going to talk about the new Fannie Mae 7% stuff that everybody's been hearing about. Then we're going to go in and he's going to walk you through step by step. I'm going to grill him on exactly how you can get traditional funding and only have to put 10% down on STRs. We're not just talking about, second homes or vacation homes, and there's some different things in it. And the other thing that I like is when I had a conversation with our guest a few days ago, he told me that he can actually write up to $748,000. That's $748,250 to be exact. So without further ado, let's bring in our guest, Mr. Jeff Chisum. How are you today, Jeff?
Doing great, Bill. It's great to be here. Thanks for having me.
Well, we got a little bit of a weak internet connection, it looks like. But Jeff, why don't you give some backstory? You've been writing mortgages for over 12 years, over 2,000 of them across the country. You're the expert, the number one guy that I could find in the country that's actually getting people like me that are investing into vacation rentals, short-term rentals, 10% down. How do you work that magic, and how did you come about to get into this space?
Yeah, so, I'm one of the survivors. I got into the business the year of the crash. So we've been writing loans for a long time. What was in the space of consumer direct with some of the big banks, and then shortly realized I needed to be aligned with a company that just does mortgages to be able to survive in this space. So, kind of fast forward to where we are today. The things that we are the most interested in are the things that we are going to inspect, dissect, research. And so just through my own experience in purchasing short-term rentals put me in a position to even dive deeper than I ever had before in the financing opportunities. So, that's where it put me in a place where I wanted to be able to help people do the same thing that I'm doing. And I found that there was a huge opportunity because of misinformation, people just being misguided, other loan officers not knowing Fannie Mae's policy and being up to date to it, to be able to show people this opportunity, this lower entry point than they had ever understood before. So that answer all of your questions?
Yeah, that's awesome. Why don't you, before we really dive in, so there's about a handful of states you do not service. So you're a nationwide mortgage lender, right? I think I got them right. No California, no Montana, and then there's like 3 or 4 up in the Northeast you don't service. Can you tell us what ones those aren't? Because everywhere else you can write loans, correct?
That's correct. So it's basically north of New Jersey or northeast of New Jersey. So there's, a handful of states. If you go to 10percentdown.com, states we serve, it'll show you a map. All the states that are in orange are the ones that we can do. So love those states. Every single one of them we're doing fun stuff in them.
Awesome. So let's dive right in. Let's talk about the recent updates to Fannie and Freddie. And we've heard a lot about the 7%. Kind of tell us where we're at with interest rates and how the changes recently are going to affect short-term rental investors.
Yeah, so Fannie and Freddie, with directives basically from the federal government said that, we want to minimize our risk or our risk pool. And so the most risky loans are the ones that people don't live and eat in. So they're primary residences. So nothing happened with those. So they looked at second homes and investment properties. And the directive, and this has been kind of lingering for a few years, but push came to shove and they're finally doing something with it, where they wanted their overall portfolio of loans to be 7% or less when it came to the mix of all the business that they do. So 7% of their loans or less needed to be, or 7% of their second home and investment loan portfolio needed to be reduced from about where they were before, which was about 12%. So, who does that cascade down to? It cascades down to the companies that are originating mortgages. So, Fannie and Freddie doesn't have, control of that other than they make the rules. We're the ones that write the loans. So it basically, they said, you guys figure it out. We're not going to tell you how to do it right now, but we're going to tell you what you need to do, which is you need to go from 12% down to 7%. And that happened to be our numbers with Gateway. We had 12% of the loans that we were originating were investment and second homes. And we needed to find out how to get that number to 7%. So I can tell you Gateway chose a game plan to no longer do investment properties if your credit score is below 700. And then if your credit scores are below 700, you're going to pay a premium to do a loan as a second home. So you're going to pay a much higher interest rate. Now, if your credit scores are above 700 and you want to do a vacation home, you're still going to get really good interest rates. They're going to be a little bit higher than they used to be, but we're not talking 1-2%. We're talking maybe 0.25%. So if you've got a primary residence, you get a 3% interest rate. Your interest rate for a second home, if you've got good credit, is going to be more like 3.25% as an example. So
we can still get those under 4, which is nice.
Yeah, absolutely, and it's still going to be better than anything else that you can find out there.
So, where does the 7% interest rate come in? Is that the person that's trying to buy an investment property with a 651 credit score, or is that all 100% a myth?
No, yeah, where the 7% comes into play is that percentage of the portfolio that consists of vacation homes and investment properties. So that's where that 7% came out or has been floating around, is we want you to go from, or we need our portfolio to go from 12% down to 7%. Now, I will say that other mortgage companies, that's completely the way that they've decided to reduce those number of loans coming through their company, is to significantly raise the rates on those two different products. So yeah, there have been higher interest rates that come about through these changes, and every mortgage company is going to be a little bit different in the way that they're trying to achieve these different levels.
So I think that's a really important delineation, because I got my ass ripped on my Facebook page for passing bad information, which was not accurate, because I was referring to my bank that I bank at, and this is institution by institution, right? So you might be able to get somebody qualified with a 670 credit score at 4%, or that extra quarter or half a point, right? Where another bank might be doing 6.75, 7.25 to get their 12% down to 7%. Is that accurate?
That is absolutely right. Yeah. So Fannie and Freddie didn't say, hey, mortgage companies, mortgage originators, here's how we're going to achieve these levels. We're going to leave it up to you to try to correct, what we're trying to accomplish.
So tell me about the 10% down, Jeff, because this is really the interesting thing in the conversation that we had. I believe it was a 540. Most people think it's like 540 or 580. I don't remember the number. 540,000, 580,000 is the max. But you actually have a way through your systems to get people to qualify for 10% down on a traditional Fannie and Freddie qualified loan up to $750,000, $748,250. How do you do that, and what type of qualifications do I need to be eligible for that?
Sure. So most of what I talk about and what we can do fits in the Fannie and Freddie box for qualifying. So it's all set by them, their standards from a qualifying standpoint. But yeah, what that is you take that first mortgage to keep it under the conforming loan limits. So Fannie and Freddie say, hey, we'll do loan amounts up to X amount. And this year, that X amount is 548,250 for most areas in the United States. And then we can take a second mortgage at 200,000, and that's a gateway internal second mortgage. So other companies may even be able to do more. So I know what we can do, which is that $200,000 second, and then with your 10% down, that's going to put you at a max purchase price of about 830,000.
That's awesome.
And,
What
and
type
still
of
be able to do the 10% down. Still,
what type of credit do I need to qualify for that?
you typically want over a 700 credit score to be able to execute on that.
And what about debt to income ratio?
Debt to income ratio are still going to be Fannie and Freddie standards. So, ideally you want about a 45% debt to income ratio, but it's going to be what the system will allow. And that's the other change that Fannie and Freddie came out with this directive to go from 12 to 7% is we have to have system approvals. So you have to be able to run everything through the machine, and the machine has to tell you, yep, we like it, we approve it. So there's no more manually underwriting files for those products. So, their potential, if you've got a really strong file with credit, a lot of reserves, that we could get an approval up to 50%. It's just, it's rare. So we typically will go with a more conservative, hey, usually we can get an approval at 45% or below, which is better than jumbo. Jumbo, you go over that 548,250, you get in the jumbo loan space. Typically, they want debt to income ratios that are 42%, 38%, and then sometimes 12 months of reserves. So that's the big deal about being able to keep it under that jumbo space.
And I mean, for me as an entrepreneur that doesn't have a job, which I think is probably a pretty high percentage, you would probably know better than I of the people that are doing the more than just the second home, but building short-term rental portfolios, right? I can't emphasize for those of you that are listening enough, that's a huge change. I bought my most recent, 2 properties ago in September, and my revenue had declined in 2020 from 2019. But I had a very intimate relationship with my mortgage banker, Mike Stapp here at Pinnacle Financial, and he got a manual, Jeff. And because of my relationship with the bank, he got a manual approval. And I literally was hosting a live event. So I was able to generate almost $100,000. We postponed the close from like August 21st to right around Memorial Day. And so I could get my revenue up because they didn't care about EBITDA, right? They didn't care about cash at that time. It was just my revenue had gone down. They had to see a trend go up. I bought 2 weeks, and then I was able to generate my revenue. So that's the type of stuff that's like completely gone today, right? That you plug in the data into the database, they say yay or nay, correct? And that's what you're referring to as a manual?
Yeah, absolutely. So there's no kind of common sense, hey, Bill, he's got this and he does that and he's got these strengths and, kind of that common sense approach. It's literally the machine is reading the data, analyzing it, and it's going to tell us whether it likes it or not. So now there are some opportunities out there with some portfolio lenders, some hard money loans where they can look at more of a big picture when it comes to a client's overall strength and health. But yeah, this space that we're talking about with Fannie and Freddie, it's a small box, but if you can fit in it, it's a great opportunity because of the terms.
So is 748 your highest level that you're able to loan on the 10% down? So somebody just commented here, they're asking, how do we get any options for higher loan limits, looking at, $1 million. Can they do a 20% down? Can you write $1 million, or are you maxed out at like 748 on the 10% down?
With 10% down, that is our limit when it comes to the 10%. I have opportunities to do the jumbo loans, absolutely, but yeah, then we're talking about 20% down payment.
Gotcha.
But you can still buy it as a second home, absolutely.
That's pretty awesome stuff. So 10percentdown.com, not the number 10, TEN, percent, spell it out, PERCENT down.com, 10percentdown.com. That's how you find Jeff. The other way you find Jeff is right. If you're one of the Superhost library members, he's right here. He's inside of our group. He's inside of our free members only group. If you're on YouTube, you need to join Build Short-Term Rental Wealth, my free Facebook group. We've got 3,600 members in it. We're talking to Jeff Chisum today from 10percentdown.com, just to kind of reset for people that are just joining us and also on YouTube. Jeff is the founder of 10percentdown.com. He's been written over 2,000 traditional mortgages at 10% down since 2008. He's just dispelled the rumors and speculation about the recent changes to Fannie and Freddie. And there's three things that stick out to me from what Jeff has shared. Number one, it's not 7% across the board from an interest rate. You can still get 3.25%, but it's institution by institution. Jeff is writing second home loans at 10% down at like still at sub 4%, right? So if you're in that market, if you're not in Montana, you're not in California, you're not in a handful of the states up in the far Northeast, like Maine and New Hampshire and a couple of those, then reach out to Jeff and talk to him about your financing on your next short-term rental. Jeff, what else should people know about preparing to come to you? So I asked you about DTI, right? And you said that Fannie and Freddie are looking roughly at about 45% if they're under 748,000. So what are some others? Is there other things they can do? So it's a little bit different with commercial loans and that type of stuff. Like you said, portfolio loans. So I've been doing myself mostly commercial. I put this whole friggin' package together, when I'm going in to do commercial loans, right? Does that help when somebody comes to you, or is it strictly DTI and credit score?
It really is. Yeah, it's credit, income, and assets. So, your creditworthiness, your ability to support your monthly obligations that you're committed to creditors, and then the acceptable assets to use for down payment and closing costs. So, I talk to people all the time that, they want to know the answers before they ask the questions a lot of times. Right. So, if I'm going to encourage someone, kind of forget what you know. Literally get 10 opportunities a day to dispel rumors or when people have been misguided or given the wrong information by loan officers, by realtors, just because 10 years ago things were done one way and they've been telling people that same thing. But literally this stuff has changed within the past 2 years, and it just keeps getting better in this space. We had a policy added just in March that said, hey, we've had underwriters that have said, well, this property it's been a short-term rental. Obviously they're going to buy it for that now. They can't do a second home and buy this property. And Fannie Mae came out last month and said, no, if the lender finds out that it used to be a rental property, we don't have a problem with that. They even have the rider that you sign about occupancy that says, basically, we understand that you're going to be using this as a short-term rental and we're okay with it. So I would say, kind of forget what you've been told or what you may know about buying. And here's a big mind shift that people have to make when they're talking about financing is stop calling it an investment property, because when you mention that word to a loan officer, they're going to say, okay, great, I'd love to help you. You're going to need 20% down, and your rate is going to be up here versus what it could be with a second home, which is about 2% lower. So that's been a big opportunity that I've had, is to re-educate people and really have almost had to brainwash people because they're so ingrained in that thinking of the policy and what it's been 2 years ago. From a debt to income ratio standard, if you want to calculate what would I qualify for, it is as easy as taking your gross annual income, dividing it by 12, and then you multiply it by 45%. And then from there, you take your monthly obligations, so any mortgage payments, any car payments, any credit card payments, deduct it from that amount. And that's what you have left over is the monthly mortgage payment that you could absorb. And then you got people all the time that can jump on mortgage calculators and figure out what the mortgage payment is. So
Jeff, is that all that we need to calculate for DTI? We don't need HOA fees. We don't have to calculate life insurance payments, anything else, just mortgage, PMI if we have it, insurance, car payments, credit cards, that's it?
That's a great question. So I would throw in there HOA fees. So whether it's on your primary or another property that you already own, HOA would be one of them. But yeah, no life insurance, no electricity, no car insurance, anything like that. It would be anything that would show up on your credit report is basically the way to put it. And then if you've got a long-term rental, you can offset that liability or that obligation out of your ratios if you have an executed lease agreement in place.
So an executed lease agreement for LTR, long-term rentals, when will Fannie and Freddie acknowledge my income from short-term rentals? Is that one tax return? Is that two tax returns? Is that never?
That's a great question, and we get that all the time. So it's 2 years of you receiving the income from that property. So it's not the history of that property receiving income, it's your reported history. So what shows up on your tax return. But that is, encouraging that, hey, 2 years down the line, I potentially could offset this short-term rental to free up space to do another one with conventional lending.
So will Fannie and when you say 2 years, does that mean I have to file two tax returns on that? Correct. So it could be up to 2.5 years. Like I bought a property in September, right? So I've got to file my 20 tax return, my 21 tax return. So it's really going to be 2022 before I'm going to be able to leverage that income that's coming in from that short-term rental. How does Fannie and Freddie look at that short-term rental? If I've got a $2,500 a month mortgage, but I'm literally cash flowing, let's say I'm doing $10,000 a month in income and $5,000 net, will they remove that from my DTI, or are they still factoring the debt service into my DTI after those 2 years?
Well, the income is going to, hopefully at least offset the monthly liability. And then if you show more income than the liability, then yeah, you can use that towards your buying power and lowering your debt to income ratio.
Awesome. Those of you that are jumping in, and I see, like, I'm going to show this here. It just says Facebook user. Jump up above us, click that link at the bottom, so that way I can see who's asking the questions. Jeff, can I only have 1 second home, or can I have 3, 4, or 5 second homes?
That's another great question. So a good example would be, you got a primary residence with a mortgage that's in your name. You can have 9 second homes. 9 second homes, everybody. So we're getting enlightened here. Jeff's dropping some knowledge bombs. I had no idea that I could have 9 second homes. Now, but the fundamental difference, right, is really the only difference is, like, I've done commercial loans, my last 2, and that's not going to show up on my DTI if I have that through an LLC. That's really the only advantage that I'm aware of. Would you agree with that? So as an example, I could have got a traditional loan at probably around 3.1%, 3.25, 3.25 at my last purchase, and I paid 3.85. So almost 3/4 of a point higher. So to keep it off of my DTI, so I increase my buying power.
so a lot of this, Jeff, would you agree that plays into, you really got to pay attention to your DTI, your income, exactly what your DTI is going to be for the future, because it's not something we can just literally, flip a switch unless you have the cash to pay off debt. And as another example, the last traditional loan I did when I bought my lake house, when I had to go into the manual, I had to pay off my wife's Land Rover. It wasn't significant. Well, I mean, it was like $18,000, but that reduced a $900 a month liability. And I think these are things that people don't understand of the steps that they can take if they're not fully prepared. And for me, and I'm interested to hear your thoughts, the DTI is, I think, the hardest thing for people to calculate. But for me, I think it's the most important, whether I'm going traditional or even if I'm going, commercial. A lot of people think, well, hey, I can get 10% down from Jeff, and that's going to put my DTI at 45%. Then I'm going to go commercial. Well, you still need to be able to have enough carrying cost cash, in case something dramatic happens like COVID. So how do you recommend to people? What would you tell them? Because I think a lot of people are really attracted by the 10%. And you know what? I'm probably going to be in the future too. Unfortunately, my next property I'm buying is in Montana, so we can't work together on that. But I'm going to go into one of those other states with you. So does the percentage vary, or does the qualification vary state by state? Or is it the same because it's Fannie and Freddie in every single state across the country that you service?
Yeah, the latter. So Fannie and Freddie set those standards. We're a bank that really doesn't have any overlays. So, really what Fannie says or Freddie says is what we can do. And as far as the property limits, there may be some people right now that are saying, oh, that guy's crazy. I know for a fact that my very seasoned, experienced loan officer told me that I can only do 4. And that can vary from institution to institution because of their overlays and their willingness to accept certain risk. So yeah, you very well could have had a loan officer that said you can only do 5 mortgages, but the truth is you can actually do 10 mortgages in your name. So we've got husband and wife, spouse, that one, they've got big picture strategy, and they knew the rules from the beginning. So one will take out a mortgage, the other one will take out a mortgage, and they understand they individually could carry 10 mortgages in each of their names and combined have 20. So it could get that big.
I think the Duffleys are listening to that right now as they expand their empire. That's awesome. I have no clue on the answer to this, Jeff. What's the answer to this? Second homes, can there be more than one in the same county or no?
That is one of those scenarios where there is it's got to make sense. An underwriter can use their discretion. So it really has to make sense. So there's a rule, I call it the bigger and better rule. So Bill, let's take your lake house, for example. I'm pretty sure it's on the lake, right? It's you got a boat dock, but let's say the year before that, you had purchased a home in that area. It had a lake view. It was 3 bedrooms and 2 baths. And you lived there for a year and realized, hey, this isn't big enough for our family, and I really would like to have something on the lake. So then you find this house at 5 bedrooms. It's 3 baths. It's on the lake. It's got a boat dock, but it's only 2 streets over. You absolutely could do that property as a second home because it meets the bigger and better rule. Now, the key is that a year has gone by since you purchased that other property.
That is good stuff. Nicole Okii, you don't write in Canada, do you?
I don't, unfortunately.
So cool. So that's it. Let's see how many. So we answered that. Can you get country, same county? Awesome. You've answered all the questions. Anything that we didn't cover, Jeff, that you want to kind of wrap us up with?
Well, the other thing that I would say about the county is you could have different destination areas in the same county. So if you have, two distinct different destination areas within the same county, that potentially could be a makes sense. Hey, we like to go over here, but within the same county, there's something totally different that we like to go and do and spend our time in. Because ultimately, with the second home, you're saying my intention is I'm going to occupy that property at some point during the year. And Fannie has the most liberal policy when it comes to that. So they don't say amount of days, they don't say a percentage of the year. They just say that at some point you plan on occupying that property. And then after a year's period of time, those rules change. You're really just committing to that for at least a year. And then you could turn that into a long-term rental potentially if you wanted to. So there's a lot to it. I love to visit with people about it. So it is as easy as going to 10percentdown.com, scheduling a consult call, and absolutely my most favorite conversations these days is to explore these opportunities with fellow short-term rental owners like myself.
So I think that's something that's really important to everybody that's watching. Jeff is not just a mortgage banker. He's a host, just like you and me. He's an investor. He has short-term rentals. He knows what we're going through, and he's here to help you. That's 10percentdown.com. TEN%, spell it out, 10percentdown.com. Jeff, thank you for joining me today. I really appreciate it. Thank you for being a member of the Superhost Library. And if anybody has any questions, just tag Jeff. Tag. He's there to help you. Really, actually don't do that. Go to 10%down. Go to 10percentdown.com and schedule a free consultation with you. Thank you, Jeff.
Appreciate it. Appreciate the time, Bill.